Okay, thank you for joining myself, Ryan Baradas, for those of you that don't know me, and my partner, Vincent Bruno Forte. We are excited to present this quarter's episode of WP90X, 90 Minutes of Extraordinary Education. Hopefully, we will fulfill that lofty goal in our title. But what we're going to be going through is a strategy that's surrounding estate planning for qualified plans post the Secure Act. Um, just to go through some housekeeping items for everybody, we will have CE and CPE credit for today's program. It's going to run approximately 60 minutes and it will be worth 1 credit hour. And what we want to make sure is that you look for and answer all NASBA required polling questions. So we will have polling questions that will pop up as a requirement for us to be afforded the ability to give CE credit. There will be 3 separate polling questions that we need you to answer, and you're not going to be graded on right or wrong answers. Just please make sure that you submit a response if you would wish to receive the credit. So please answer the polling questions. We'll prompt for those who have yet to join us. In terms of Q&A, Vince is going to be monitoring the Q&A section and we'll be asking those questions. We really want this to be an interactive and educational webinar. So please type your answers into the Q&A feature in the bottom of your Zoom toolbar. Don't use the chat function, use the Q&A function. And if you have any additional questions, including technical items, please message the WealthPoint team, or you can reach out to Kristen at wealthpoint.net. And the presentation and a copy of the recording of the presentation will be sent to you after the seminar. Also, as a requirement of offering CE, we need to do a survey. So if you're interested in receiving CE or CPE for CFPs, having that credit for attending the webinar, please look for and complete the survey that's going to be sent to you. And then once we have all of that information, our certificates will be emailed to you within 30 days of this webinar. But again, please use the Q&A feature in your Zoom chat bar, toolbar, I'm sorry, for any types of questions that come up. In terms of our overall learning objectives and agenda, what we're going to do is define RAMP, and RAMP is the Retirement Asset Maximization Plan, how it works and where it fits, where it's appropriate and where it's not appropriate. And we're also going to understand the provisions within the tax code that allow this strategy to work, and identify how life insurance is utilized and understand different products and funding strategies for this program itself. So just in terms of going through just an overview, RAMP is really utilized for clients that have at least $1 million or more in their qualified plan, and at least 2 to 3 times that in other outside liquid assets. But most importantly, your clients, these would be clients that have large qualified plans that they've accumulated over their lifetime, but just don't plan to use for retirement funding or retirement cash flow. And so these are assets that are just going to compound over time, be forced out in terms of required minimum distributions, and then eventually left to heirs or charity. And so the whole goal here is to figure out, do we have a strategy, and go through this unique strategy to help either maximize net to heirs or maximize net to charity. We're going to go through a case study. We find that that's the best way to go through these types of strategies. And this is a client, Bill and Amy. They've got 3 kids, and they've got a pretty sizable net worth. Their net worth is in excess of $50 million. They've got $5 million in qualified plan assets in the form of an IRA, and have determined that they really just don't need that cash flow for their retirement assets. And the reason is they've got cash flow from business real estate. They had sold and gone through a value realizing event and had sold their company. have a large portfolio of securities, well in excess of $20 million. And then they also have rental income from a couple of business pieces of business real estate that they retained post-transaction that are well above and beyond their current cash flow needs during retirement. And their current estate plan dictates that they leave the assets to each other at the first death and then equally amongst their kids at the second death. And they've not used any of their exemption equivalent to date. And their objectives are really to improve the use and enjoyment of their wealth, the Smith family wealth, maximize the assets, in this case, left to heirs, but we'll go through an example of if they didn't have that and they wanted to leave the residual benefit to charity, which is most common advice, and we'll go through that in a minute, and really increasing multi-generational wealth. So, and if possible, to maximize the growth and flexibility on a portion of their traditional investments. But that's the overall case study. And again, for those of you just joining us, if you do have a question, please don't hesitate to ask that question, and you do it in the Q&A function on your chat bar. So as we look at the challenges and impact, in terms of the challenges for these clients, they have required minimum distributions that are going to begin age 72 on the client's retirement account, regardless of whether they need it or not. It's effectively just a force that money out of the plan. So the client has to start recognizing the taxable income that's been deferred for a long, long period of time. And then eventually, we've also got double taxation on those retirement plan assets at the second death. And so that means that income and estate taxes are paid. And with Bill and Amy, we've got them as Arizona residents. And so if we look at the impact today, there's estate taxes of $2 million on the $5 million qualified plan balance. We have income taxes or IRD that will be owed. That's just under $1.3 million. And the heirs are getting 34 cents on the dollar. So $1.7 million going to the heirs. If we fast forward to 15 years into the future, we've still got a big problem. We've got estate taxes of 4.1 million, income taxes of 2.7 million. You'll see the amount going to heirs is going up. And that's because we're assuming that there are required minimum distributions that are being reinvested in the after-tax portfolio, starting again at age 72. But we've got still a tremendous amount, over 6.8 million, that's lost to taxes, combination of income and estate taxes. The conventional wisdom that we find is not all that attractive as well. So in their case, they were just planning on doing required minimum distributions during their lifetime and then leaving it to their kids. And there's a double tax. You're recognizing income tax along the way on the distributions, and then eventually have both the state tax and IRD on the residual balance that's there and left to the kids. Another thing that we could do is a Roth IRA conversion. And in that case, we still have a double tax. All we're doing is accelerating the tax liability to whenever we do the Roth conversion, paying the tax today, and then that compounds tax-free during their lifetime. But then eventually there's a state tax owed on that balance as well. The most common advice that we see amongst practitioners today is to do RMDs during your lifetimes. And if you don't need the money, you can just continue to reinvest it into your after-tax portfolio and then just leave the balance. Change the residual beneficiary designation on the qualified plan to a qualified charity. And so in that case, it's taxable and they're giving it away. And lastly, we have the stretch IRA that was utilized a lot by practitioners up until the changes imposed by the Secure Act, which it's now limited to 10 years post-mortem. So there's a requirement to recognize that income tax within 10 years of the date of death. So none of these are really great strategies, but these are the most common strategies and advice that are given to clients. And again, the most common is require minimum distributions and then leave the balance to charity. And we'll show what that looks like after we go through the initial fact pattern, remembering that Bill and Amy's current strategy is to do RMDs and leave the balance to their kids. So we're going to go through polling question number one. Kristen, our Director of Communications, is going to launch that question. And if you wouldn't mind answering that, that would be wonderful. And I'll keep going. The polling question is going to remain up for about a couple of minutes, but we're going to go ahead and you can minimize it if you need to, but we'll continue to move through the presentation itself. So what is RAM? Again, it's a retirement asset maximization plan, and we often get credited as that a technical industry term, and no, it's a WealthPoint branding of the specific strategy, but this is something, it's not something proprietary to WealthPoint. We have our proprietary modeling and everything else, but this is just utilizing some provisions within the tax code and just some smart entity structuring that allows us to do it. But it's simply just an asset repositioning strategy that's designed to address two primary tax challenges. And the first one is to eliminate income and estate taxes on the qualified plan assets, and then also eliminate ordinary income and capital gains taxes on a portion of the traditional investments. And this is the 20 plus million that the clients have in their after-tax investment portfolio. And in terms of the cost, it's an out-of-pocket cost of typically less than 1% per year, and usually 15 years or less. In this case, you'll see it's 13 years of the initial value of both buckets of money, the qualified and the non-qualified plan assets. And so if we add those two together, we've got 2.7, just under 2.780 million. So it would be less than, or I'm sorry, 7.780 million. It would be less than 1% of the combined two buckets of money, or 800,000 a year for 15 years or less. And you'll see where that comes in. But that's to move both buckets of money from currently a taxable world into a tax-free environment. And that's the goal. And we'll go through exactly how the strategy works step by step. And again, if there are any questions, please don't hesitate to put your question in the chat bar as we go through it. So step one is really to move from their current retirement plan, and I would say majority of the time it's an IRA, and so we need to migrate that IRA into a profit-sharing plan environment, or we'll amend the plan document if we have an existing profit-sharing plan to allow for the purchase of life insurance. This money would qualify as seasoned money. And under the seasoned money rules, it allows for the purchase of insurance inside of the profit sharing plan. And in order to create a profit sharing plan where we don't have one in existence, we need to have earned income. So a lot of clients have, and like in this case, they have the business real estate, and we can put the business real estate in a holding company structure and have some some income paid up to an upstream entity, and we can create the profit sharing plan in that entity. Or in this case, also the clients have board income. The husband is serving on 3 boards, and he's got about $240,000 of board income. We can have those board fees paid there, but we need an entity where they have earned income. And then we roll the IRA over into the new profit sharing plan structure, and it's a plan-to-plan transfer. There's no tax. And we need to make sure that that new plan is, or the existing plan is either amended, or the new plan allows for the purchase of life insurance. And again, since this is seasoned money, it would qualify as seasoned money, and it has to come from a defined contribution plan. it would allow for the purchase of life insurance. The next step is we're going to have that policy purchase a properly designed life insurance policy inside of the plan by making a series of premium payments. And that's a technical term by the IRS. It has to be more than one. So we can't just make a single premium and do a MEC. We want this to be a non-MEC policy. And quarterly payments don't count as more than one payment. It has to be more than one annual payment. And in this case, we're using a joint life policy or a survivorship policy on the lives of both Bill and Amy. Again, it's structured as a non-MEC or a non-modified endowment contract policy. And that's important because that still affords us the ability to have the policy qualify under FIFO, which is first dollars in, first dollars out. And the initial death benefit of that policy is going to be $21.1 million. And we're not getting a lot of leverage. Normally, with $5 million of premium payments, you would see a policy in the $25 to $27 million range. But in this case, we need the policy to have adequate cash and be overstuffed with cash for what we're going to do later on down the road. The next step is we need to create and fund an ILID, or if we have an existing irrevocable trust in existence, we can use that. We want it to be structured as a grantor trust, and ideally, we'd like that trust to also be generation skipping transfer tax exempt. And we're going to, in this case, they did not have an irrevocable trust, so we've created a brand new irrevocable trust, and that's going to be the future owner of that life insurance policy that currently resides inside of the profit sharing plan. And we're going to fund that ILIT with cash, and it's going to be funded with part gift and part loan. And the gift is going to be $1,573,000 is going to be gifted, and we're going to use both their lifetime exclusion amount and their GST exemption for that gift. So this trust will eventually be all GST exempt. And then the clients are going to loan $1,207,000 or 201 to the trust as well. If you add these two numbers together, that's that 2.780 million or 2.7 and change of the small portion of their after-tax investments. Again, in this case, we said over 20. It was about $27 million in total portfolio that they had. But of that 27 million, we're using $2.7 million in a loan. And the reason why we're doing $1,201,000 in loan and $1,573,000 in a gift will make more sense as we go along. But again, we're loaning $1,200,000 and we're gifting $1,573,000 to put that $2.774 million into the irrevocable trust. There will also be some small gifts that will be required by the grantors for interest payments, and that will make more sense as we go. Or we could just do a larger gift at the onset, but that's an option that can be discussed on a case-by-case basis. And again, we want to make sure that this is a grantor trust for a variety of reasons, but not the least of which is the next step, which is we're going to buy that policy out of the profit sharing plan for the fair market value. And there are two provisions in the tax code that we're relying upon. The first one is the fair market value of a life insurance policy. And so some of you may remember life insurance bought in qualified plans, and they would put $1 million into a policy, and then it would have a value for valuation purposes of maybe 10 cents on the dollar. And then they either distribute it out of the qualified plan or they would buy it out of the plan. And then all of a sudden the cash values would spring up. And it was the old springing cash value policies. And the IRS said, time out, that does not work. And so they put the kibosh on those transactions and then eventually came out with a revenue RevProc 2005-25, and it's a safe harbor ruling that says if you value the policy with at the greater of ITR, interpolated terminal reserve, which most people know about and are familiar with, the greater of ITR or PERC, which is premiums plus earnings minus reasonable expenses and charges, the greater of that value, that is falls under the safe harbor ruling, and you're okay with that transaction. And in this case, that value for this policy, because of the type of policy and what we bought, is 2.774 million. So that's that portion of the after-tax portfolio that we're using for this transaction. So it represents an approximate discount of about 45%. And now we have a policy that is GST and estate tax free of 21 million outside of the taxable estate. The other provision in the tax code that we're utilizing here is PTE 92-6. And that is all these tax citations are going to be in the back of the presentation that you'll get after after we're done presenting. But PT 92-6 allows for a grantor trust because the IRS treats the taxpayer and the trust as one and the same for income tax purposes. It allows a grantor trust to buy a policy out of a plan. And so we're just using those two provisions, one safe harbor ruling to make sure that we don't get challenged on value, and then PTE or prohibited transaction exemption 92-6 to allow for a grantor trust to buy a policy out of a qualified plan. So after step one, we've done two things. We've done a good thing and we've done a bad thing. The good thing is we've taken $5 million that was subject to double tax in terms of estate taxes and income taxes in the form of income in respect of the decedent. And we now have 21 million outside of the taxable estate in a GST exempt trust. But the bad thing that we did is we took money that was in an after-tax brokerage account where you can tax loss harvest and do all kinds of things there, and we put it back into the retirement plan, which is now subject again to double taxes and fees. We're going to solve this problem with step two, though, and we'll get to that in a second. This formula at the bottom was really something that one of our clients had pointed out to us. He said, so what you're really telling me is my $5 million retirement plan would need to grow to $62 million in order to equal $21 million outside of the taxable estate. And I asked, where did you come up with that? And he said, it's easy. I took the ending balance, or 21 million, and divided it by 1 minus the tax rate. And if we've got 66% in combined income and estate taxes, or 34% total, we divide 21 million by 34%, and that would equal 62 million. So I'd have to grow the retirement plan to 62 million in order to equal the same amount of assets on a net to heirs basis. And I said, well, that's true. Those assets would not be GST exempt. These assets are. And so that's one of the big benefits of this is we're creating that $21 million asset that's now income tax free, estate tax free, and exempt from generation skipping transfer taxes. Again, if you have any questions, please don't hesitate to ask a question in the Q&A chat bar. So in step two, remember, we did a good thing and we did a bad thing. The bad thing, moving those qualified or non-qualified assets or the taxable portfolio into the back into the retirement plan. So what we're going to do is simply convert now that IRA into a Roth. And that's going to generate the first and only income tax liability that is going to need to be paid here, but we're not going to have the clients pay that tax liability out of their pocket. And so that tax liability, if we assume a 40% tax bracket, is $1,201,000. But again, they're not going to pay that money out of their pocket. And now we have this 2.7 million that is going to continue to grow tax-free. We're now exempt from having to do RMDs and will be still subject to estate tax. We've still got the Roth IRA included in the taxable estate, but it's subject to estate taxes. But the next question is, how are we going to pay that? We just converted to a Roth, and we have $1,201,000 that's due to the IRS. Well, we're going to use that policy that was just bought out of the retirement plan. Again, remember, we didn't get that 5-to-1 leverage that I talked about. It was only 4-to-1 because we wanted that policy to be pretty fat with cash because we're going to use it for as collateral for just simply a life insurance backed line of credit. And so we have several banks that we work with, but it's essentially you're going to the bank and using the policy's cash value and death benefit as collateral for a loan. And that loan is $1,201,000. That happens to coincide, if you remember, we funded this trust with part gift, that $1,573,000 plus the $1,201,000 loan from the grantors. We're going to take that loan from the bank and we're going to pay back the grantors for the original loan that they made, and they're going to turn around and use that money to pay the IRS for the Roth conversion tax liability. And so now what we have is we've got interest payments that are going to be due back to the bank, simple interest payments for a period of time. Again, like I said, I'm skipping ahead a little bit, but for 13 years, we're going to have to pay interest payments to the bank for a period of time. At the end of that 13 years, first, we've paid simple interest on that loan for that 13-year period, and that's going to be gifts made by the grantors, and it's a total out-of-pocket cost of $858,000 on a Roth conversion tax of $1,201,000. But instead of paying that $858,000 all up front in the year of the Roth conversion, we're going to be paying it 66 grand a year annually for 13 years. And this is assuming a 5.5% interest rate for the duration of the loan. Now, we have also, this is all built on a proprietary financial model. So we get lots of questions. What if I get a higher rate of return on my investment assets? What if I have to pay a higher rate of interest on this Roth conversion loan? We're going to go through and change some of those assumptions so you can see the ripple effect. But if essentially I'm paying simple interest on that $1,201,000 for 13 years, and then eventually that loan principal is going to be repaid from the policy cash values via tax-free withdrawal, or it can be also paid by the policy's death benefit if the client were to pass away during the period of the loan. Or if the client wanted to, they could pay it with out-of-pocket expense or out-of-pocket funds. But we recommend that the proper structure is to go ahead and pay it as a tax-free withdrawal out of the policy. So in this scenario, the policy's loan or the bank loan is going to be paid from a tax-free distribution out of that policy. So now we're going to move on to polling question number 2. And so, again, please answer if you're looking to receive CE, please answer the polling question. And you can always minimize it, but I'm going to continue on with the presentation. So now, at the end of the day, we've moved both buckets of money. Yes, sir.
We have a question.
Yes, sir.
Question is there a recommended minimum time between when the policy is purchased inside of the profit sharing plan and when the islet then purchases the policy from the profit sharing plan. What factors do you consider in this regard?
Yeah, normally this is anywhere between a 3 pay and a 6 pay. I would say on average it's a 4 or a 5 pay. And so you pay the premium at the beginning of the year. And in this case, it's a 4 pay. So if you've got $5 million, and if we assume no interest is earned on that $5 million during the premium payment period, that would be $1,250,000 a year for 4 years. After I paid the fourth year premium, which is really at the beginning of the fourth year, or essentially in the third year, then we're going to buy the policy out of the plan. We want to buy the policy out of the plan as soon as possible. Um, and then once we buy the policy out of the plan, that's when we're going to do the Roth conversion. Another question that comes up, and this question hasn't been asked, but if I've got this big death benefit in the plan and I die in those first few years while it's still in the plan, I'm going to be subject to income taxes and estate taxes. I would say that in those cases, especially with survivorship policies, we can use the economic benefit and effectively loan that death benefit to the trust in return for the economic benefit, which is similar to a split dollar, and we can effectively get the death benefit so only the cash value is subject to estate and IRD taxes. So we can do a lot of different things with this, and we use this not as a canned strategy, very much like a sale to a defective trust. We really look at the overall fact pattern of the client. There's not just one way to do this, but we're showing you just the most common way to do this. And it generally works best with clients that are between the ages of 45 and 70. But if we get north of 70, then that changes a little bit. But uh, uh, again, we're looking for a series of premium payments. And in general, it's between 3 and 6 premium payments. The Again, to summarize where we're at now, we've got $5 million that's now worth $21 million. Again, estate tax free and GST exempt in the irrevocable trust. And we've moved the 2.774 million out of the brokerage account. It's round trip through the trust. And we've created 2.774 that's now growing income tax free inside of the Roth IRA. And again, exempt from the required minimum distributions. And in terms of total result, it results in just under 10 million more on a net to heirs basis, or 50% more than the status quo at life expectancy, which is a big improvement. So why does it work? It's pretty simple. The cost and the income tax-free benefit of the life insurance is just much better than the cost of double taxes and fees as it sits in the retirement plan. And then this is a big one. We're paying simple interest on a small amount of money, the tax loan, only for a period of years, for 13 years. And we're receiving compound interest over the lifetimes of Bill and Amy on the larger bucket of money, the 2.774 million. And you're just going to get a spread there. So if I'm only paying simple interest for 13 years and I get compound interest on the larger bucket of money for the rest of my life, there's going to be a spread, and that spread is quite large. This is just a summary. And the summary is just showing the two buckets of money. We've got the status quo, the retirement assets of 5 million and 2.774 million in the brokerage account, and then the total taxes paid over the client's lifetime, again, is 26 or 26.77 million, and the net to heirs at life expectancy, if we do absolutely nothing, is $20 million. With ramp, We end up with $30 million total net to heirs, and we paid $19 million less in tax. And if you ask, well, you've got only 10 million more, you paid 19 million less in tax. That some of that is the cost of the product. But again, if we focus on what we're accomplishing here, we're again getting nearly 50% more, almost $10 million more additional assets to the heirs, with a large chunk of those assets being estate and GST tax free. This little spike here is part of a rider, and we'll go through that on the policy. In this case, we're using a John Hancock survivorship policy, and John Hancock has additional estate preservation rider. It just falls off. It's a free rider. We don't like it. We call it the lazy insurance guy rider, but it pays a larger death benefit during the first few years. But you can see under these assumptions, and again, it's only under these assumptions. And again, the common questions are, what if I get 8% on my investments? You're running this at 6%. Or what if my loan interest rates on my Roth conversion loan is not 5.5, it's 7. And we're really looking at the forward-looking SOFR curve and looking at where things will be at the time that we make that loan. And that's why we're using 5.5%. But we'll show you what that ripple effect is. But these are the lines, and you can see that even if we look and extend out to age 105 or 106, there's a separation between those two lines. So again, in terms of the tax history, the RevProc 2005-25 is that safe harbor ruling that we're really utilizing to make sure that we don't fall into a valuation trap. And that's essentially the greater of ITR perk. And that's something that we get directly from the life insurance company. It's not something that we make up. And as long as we use that valuation, we're safe under that safe harbor ruling. The other one, again, is the PTE 92-6. And then this allows for the retirement plan to purchase the policy out of, or the irrevocable trust to buy the policy out of the retirement plan, so long as it's structured as a grantor trust. And then again, we mentioned the Secure Act as well. But when we look at this, have we really done anything crazy? And you might say, well, there's a lot of complexity. It's our job to replace that complexity with leadership. We've got the TPAs. There are TPA fees that are due to set up the profit sharing plan and maintain it during the first 4 years of the strategy itself. There may be entities that need to be created and tax returns that have to be filed on behalf of those entities that may be necessary. But those are small fees in relation to the bigger picture. But again, it's our job to replace any of that complexity with leadership and to make sure that we have all the resources there. But all we've done is bought the insurance inside of the profit sharing plan with seasoned money, which is 100% allowed under current law. We've bought the policy out of the plan in a grantor trust, which again, under the prohibited transaction exemption 92-6. We've done a Roth conversion, which everybody knows that you can do a Roth conversion. But all we've done is used, in order to pay the Roth conversion tax, we've just done a life insurance back line of credit. So all that is going to a bank and using the policy's death benefit and its cash value as collateral for the loan. We've kept that loan in existence for a period of years to allow that money to compound inside of the life insurance policy, and then eventually use the policy's cash value, a tax-free withdrawal of that cash value, to retire the bank loan. So we're going to move on to polling question number 3, simple true false question. And we'll leave that up for a period of time, you can minimize it. And we're going to go through some of the back end of this, which is our financial model. And we have the ability, for instance, this is just a generic fund that we're using, but we have the ability to use whatever capital markets assumptions are desired, usually by wealth managers, in terms of what the rate of return is that they want us to assume. In this case, we have a blended tax rate, 50% of the returns being attributed to ordinary income, 50% to long-term capital gain, a 25% portfolio turnover, but effectively an effective tax rate on the portfolio just under 25%. The best assets to isolate for ramp to use for this would be a repositioning of assets that are generating ordinary income returns. So something like a private credit portfolio or something like that, that would be the best assets to create the liquidity, use that to buy, to fund the trust, and then once it's in the Roth, reinvesting in those tax inefficient asset classes. Against it, it's just asset location versus asset allocation strategy. But in this case, to be conservative, we use the assets that are going to be fairly tax efficient. We could even use really tax efficient portfolio, but we want to try to find something that has high basis, and ordinary income type tax rates would be the most ideal. We'll get the biggest benefit from that. This is just status quo, the qualified plan assets. If we were to do nothing, we would have our $5 million. And again, we're using a 6% rate of return. That would grow to 8.9 million. And then we would have to start making RMDs. And the RMD calculation would be 326,000. We'd have tax on those RMDs of 129,000. So our net to invest in the after-tax portfolio or non-qualified portfolio would be initially 197,000 going up. Eventually, that qualified plan balance at life expectancy, which would be, again, we're using high net worth mortality, so beyond what normal folks would tell you that mortality is, but it would be the husband's age 94 and the wife's age 95. It would be $8.2 million. It would be subject to both income and estate taxes, and net to heirs would be 2.796 or just under $2.8 million. For the non-qualified assets, we use those. We're not using those until year 4, and that's when we're buying the policy out of the plan. But in order to offset, because status quo, we don't have interest expense. So we also do the ramp interest expense. We use that as deposits to make sure that we balance out the equation, and we've got an equal parts on either side. And so we show on top of that 2.774 million, we show the 66,000 a year for 13 years going in. We've got the growth, the tax, again, using those capital markets and tax assumptions here. We've got a future unrealized capital gain. We show the RMDs also being deposited into the after-tax portfolio because we want to isolate these two buckets and make sure that we have a fair comparison between the two. So we've got to add in the interest deposits, and we're showing those RMDs being reinvested. That portfolio eventually grows to 27 million. We've got unrealized capital gain of 7.6, but under current law, you get a step up in basis. So we've got the full 27.8 million or just under 27.8 million available, but that's subject to estate tax, and the heirs would get $17 million. This is the insurance policy. Again, it's the Protection Survivorship Index Universal Life with John Hancock. We're paying $1,250,000 a year in for 4 years. Immediately at the end, at that 4th year, we're going to buy the policy out of the plan. For the 2005-25 ruling, we take a loan out And that, so our 21 million, that we still have to pay that loan back. So the net that's going to be paid to the trust is 19.9 million. So we've got this loan outstanding, and then eventually we use the policy. You can see here in between years 16 and 17, the cash value goes down, and it's because we've taken out that withdrawal of 1,201,000 to repay the bank for that Roth conversion tax loan. So we've only got this expense. This is the total expense to move both buckets of money from a taxable environment into a tax-free environment. This is the Roth ramp. It grows to $16.8 million. We have the 10-year stretch that's afforded to us, but it is subject to estate tax if we were to leave it directly to the kids. So we've got the 10.1 million. So that's the total $30 million. Yes, Vince, we have a question.
We have a question. What flexibility is provided through these processes if we experience more legislative change? Would you ever recommend working these through tranches based off the qualified dollars? What would the minimum be to make sense of all the moving parts?
Yeah, $1 million would be the minimum. And we have situations. We've got a client right now that we're working with that has $40 million in their IRA. And a lot of that is because he's done a self-directed IRA, and he's invested in various real estate developments and projects and some other private equity investments. And there's a tranche that's liquid. And so we can't do ramp for the entire $40 million. And I would say that this is not an all or nothing strategy. So a minimum of $1 million is what the minimum is. And in this case, that I just talked about with the 40 million, it's only 15 million that we're going to utilize the ramp strategy, and the other we're going to continue to let defer and then eventually leave to charity, to a philanthropic organization. But it's a great question. We can do this in phases. And oftentimes, I would say the gross majority of the time, it's the entire balance, because these are, again, assets that the client is not ever relying upon for retirement cash flow. But I would say that that is a caveat. If they wanted a little bit of a security blanket, and let's say they had $5 million and they only wanted to use the strategy for 2.5, and they wanted to have that safety net, they could hold on to that. They could then do the strategy again later on down the road if they were assured that they weren't going to run out of money before they run out of breath, so to speak. But it's not an all or nothing strategy. But I would say the gross majority of the folks, they're well over the line from I need more to I have enough. And the strategy works incredibly well for them. In terms of the cash flows, these are just the current plan inflows, and then the ramp inflows. Again, the 1,250,000 into the life insurance policy, the $2.7 million into the Roth. We've got the outflows of the interest payments, which again, if we wanted to, we could just make $858,000 additional gifts. So of that 1,573,000 that we gifted, we could gift another 858,000 if we had assets in the trust, or we could just make annual gifts using annual exclusion gifting. In terms of the stress testing, we're going to go through that, but before we do that, Johnny, one of the questions that we often get is, what if I'm just, the current plan is I want to leave the balance, the residual balance, to charity. And so we would just look at the status quo. So I'm just going to, again, the most common advice is do RMDs, reinvest it in the portfolio, and then leave the balance to charity. So in this case, the charity would get 8,221,000. That's the residual balance at life expectancy that would be available to charity. And the family group would get the net after-tax amount of 17.295 million, or just under 17.3 million. So again, 8.2 to the charity, 17.3 to family. And if we compare that to ramp, the family would get 19.9, so a little bit more, 17.3 to 19.9. So 2.6, almost $2.7 million more to the family group. Not a big deal. But if we wanted to, we've got an asset that we could leave to charity. Now, I would never, I don't think anybody on this call would recommend that a client use a Roth to leave to charity, but they could leave, instead of 8.2, now they've got more than double going to that philanthropic cause. So just again, isolating the two different buckets of money, we've got additional amount that is going to charity. Yes, sir.
We've got another question here. How much does insurability affect outcomes? Is there a limit to the insurability rating that ruins the strategy?
Yeah, it does. It really depends on age. And so we need a client, if we go through, that kind of takes us to ideal client profile. We really want an individual or a couple, ages 45 to 70, again, with an estate tax that is, we have a taxable estate or potentially taxable under the sunset of the TCJA, which we believe, I'm betting on the fact that that's going to get extended after the results of this year's election. We need somebody that's insurable. Obviously, if you're buying life insurance, you need to be insurable. But I would say that you need one insured to be at least standard or better. The other insured could be slightly rated. But again, numbers don't lie. People do. The thing is, we would go through, do preliminary underwriting and see where things would come in, not get exams and everything else, but just do a feasibility study to see if this works, and then stress test it. And we're going to stress test things. Johnny's going to share the model that we use and change some of the assumptions so you can see the ripple effect. And it does make changes. Like if interest rates were, instead of 5.5% that we're assuming, if interest rates were 7%, what would that look like? And you'll see it'll make a very little change because we're paying interest on a small bucket of money. We need, again, a balance of a minimum of $1 million or more. And we typically see plans that are 2.5 to, as high as we had one as $50 million that somebody had in a qualified plan. And we need to make sure that the plan originates from a defined contribution plan, so we have the ability to adhere to those season money rules. We need after-tax investments of at least 2.5 million or more, and I would say the gross majority of the clients that we're dealing with have in excess of $5 to $10 million in after-tax investments, or have income coming in from an alternative source, like rental real estate or other income, board income, so on and so forth. They're not relying upon the plan for cash flow during retirement, and they either want to maximize net to heirs or net to charity. Vince, you had another question?
Yes. What happens when we don't have any lifetime exclusion left?
That is a challenge, but when we don't have lifetime exclusion left, a lot of times there are trusts that are already funded. And so we had that situation come up recently. And in fact, it was a unique fact pattern where the client was older, so we didn't have enough money or enough time for the money to grow inside the policy to make a tax-free withdrawal, but they had successfulully transferred over $15 million into a GST exempt trust. And in that case, we already have a funded trust. So if we've already used exemption, it's presumable that we've got a funded trust already. But in that case, we didn't do a policy loan to pay off the Roth conversion tax. What we did is a loan from the GST exempt to the estate to pay the tax. But instead of doing that loan at the AFR rate, we did the loan at 10.5%. And we did it at a higher rate because what that did, we still had that estate tax on the estate. So as that loan accrued, it was compounding at 10%, which created a liability inside of the estate to help reduce the value of the estate and balloon the value of the GST exempt trust. So again, that's a really good example of a strategy where we've taken this and we can look at it in this more canned version, if you will, but we really want to figure out what are the overall objectives of the client? What does the balance sheet look like? What are they relying upon in terms of cash flow during retirement? What other estate planning have they done? And then how can we use this as an augment to help them bridge the gap or to increase, again, increasing or maximizing net to heirs or net to charity. So with that, I'm going to turn it over to Johnny, and Johnny's going to bring up the modeling. Hopefully, if Johnny's there and paying attention, which of course he is. And so this is the baseline scenario. And so the baseline scenario, again, we're using some assumptions, 6% rate of return on the investment assets, both inside and outside of the qualified plan, and also a 5.5% loan rate. So the first question that commonly gets asked is, what happens if you change the loan interest rate? And so right now we have it set at 5.5%. Johnny's going to change that to 7%. And then we'll be able to see what that looks like. So now we've dropped because we've got a higher loan expense. We've got, what's the loan expense, Johnny, if you'll go to that page. So instead of, I believe it was 66,000, now we're at 84,000. And that 84,000 is being added to, again, the taxable account and accounted for, but the difference in 1.5 or 150 basis points on $1.2 million loan is not going to make a dramatic difference to the plan itself. It's just, it doesn't have that big of an impact because again, we're paying simple interest on that small bucket of money, the $1,201,000, the tax loan, to get compound interest for the rest of our life in the Roth. The other instance, if you change that back to 5.5%, and let's say you say, well, what if we get 8% on our rate of return on our investments? So we'll go back to the summary. Well, now we've got a steepening, and you can see that things cross over here at age 102. But every year prior to that, we're still much better, and we're still 4.3 million ahead. And the reason is that if we look at that 8%, it's also affected our Roth as well. So our Roth IRA is now, instead of being worth 16.8 million, is worth 30. But again, that the taxable investment account, that's where we're having the big impact. If we go to that page, we've got that 2.780 or 774 million plus the $66,000 interest payment and the RMDs all growing at 8%. So now our portfolio is worth 46 million and subject to estate tax. So we can play all these what if scenarios and really find out, where does it break? And I think that's one of the things that we really want to look at. For instance, if we were to leave this the rate of return assumption and increase the interest rate to 7%, what does that do? So we have the ability to do that, and you can see our crossover point is a little sooner, right at about age 100, and we're still $3.6 million ahead. But we have the ability to do any stress testing scenarios, model any type of portfolio, capital markets assumptions, income tax assumptions, whatever the practitioners, whether they be trust and estate folks, CPAs that we've worked with, and wealth managers. And oftentimes it's the entire team. We're collaborating with the entire team to make sure that we've vet this properly and make sure that it's going to make sense for the client itself. Any other questions that folks have, or again, whatever assumptions that we want to change, we can make that change. Changes in income tax rates. We can change the estate tax rates. We can, if we eliminate the estate tax, that's going to be where you'll see a crossover. But I would just tell you that just because they eliminate it doesn't mean that it can't come back during the time horizon or the 30 plus years that we have for the planning on a go forward basis. So it still could prove to be smart planning. But if Johnny, if you can stop your share real quick. So again, going back to the overall objectives, and hopefully this has been enjoyable and informative for you. This is a fun strategy for us, but hopefully we've defined what RAMP is, how it works, and where it fits. We understand the provisions within the tax code that allow the strategy to work, which again are the prohibited transaction exemption 92-6 and the safe harbor ruling under 2005-25, which was designed to eliminate those old springing cash value BS strategies that existed, and then how we use insurance to work. But we need, again, just to go back to the client profile, we need somebody that fits this profile. They need to be insurable. We can either do it on an individual or survivorship basis. We can do it on the spouse. So if we have a plan that's on one spouse, we can buy insurance on the other spouse. There are some people that say you can buy insurance on children. Well, I think that may be true. We tend to stay with just the plan participant or the plan participant and their spouse, or just the spouse. That's where we leave it. So again, thank you so much for joining. If you have any further questions, please put them in the chat function. Also, just as a reminder, please make sure that you complete, in order to get your CE, complete the survey that you will get shortly after this, and we will be sharing a copy of the presentation, also a recording. So if you have somebody that was unable to attend and you would like to share this with them, please feel free to forward the presentation materials on to your colleagues. But on behalf of Vince and myself and all of us at WealthPoint, thank you so much for carving some time out for us for this quarter's version of WP90X. And if you have a case that you would like to brainstorm, please feel free to either email or call either Vince or myself at the contact information that will be in the presentation that will be emailed to you. Until then, we look forward to seeing you next year, and wish everybody a happy holidays, and hope that 2024 finishes with abundance of success. Thank you.